Harsha, welcome to the Equitymaster Mint Investor Hour. Delighted to have you. I want to kick off our discussion by typically what we do on the Investor Hour. Tell us a little bit about yourself. Going right back to where are you from, about your household, your parents, and your initial schooling.
Sure. Uh, Thank you, first of all, Rahul, for inviting me on your show. As far as my background is concerned, I come from a typical South Indian middle class family. I hail from Bangalore. That's where my schooling and initial education happened. And thereafter, I moved to NIT Karnataka, which used to be called at that point of time Regional Engineering College of Karnataka at Surathkal. Then worked for a year in between before I did my MBA. Then I went to IIM Lucknow for my post-graduation. So that's my journey in terms of education. And post that, I landed up in Mumbai in 1996. So it's been about almost 27 years now. So in fact, I've stayed in Mumbai more than any other place that I've lived earlier. And since 1996, I've been part of capital markets. Initially started my career in equity research, then went on to become a fund manager, and currently with Kotak for last decade or more.
Decade or so, yeah. About your home, please. Your parents and your home place,
Yeah. I mean, you would be surprised to know that nobody in our family or in our extended family ever had anything to do with stocks or investments other than bank deposits, I would say. And as a typical South Indian family, the focus was on getting a good education and a good job. That was it. I mean, nobody in the family in business or in finance for that matter. But I mean, my father was a doctor and my mother was a homemaker. And typical family where good education is what you aspire for, right? But over a period of time, my fascination towards numbers kept increasing. And I would say even towards the end of my engineering, I was clear that I wanted to be in finance and wanted to pursue a career. And that's what made me do management course. And I mean, I went to IIM Lucknow and graduated in MBA finance. And thereafter, it's been journey in the equities. And also I took up internship during that period in equity research, and which also helped me to understand what happens in stocks. And obviously that helped me in getting my first job again in equity research. So I think what I wanted to, all of that actually kept falling in place over a period of time. And I've been fortunate to do what I like to do as a hobby. There are many people who would do a certain job, but they may not be really passionate about that particular function or stream of activity. But in my case, thankfully, I'm very, very fortunate that I'm doing what I like the most.
Well, it's very apparent because on a Saturday morning, you and me are recording this because we love what we do. So that's very obvious. So once again, thank you for doing this on a Saturday. So when you were doing your engineering and your MBA and you're coming home, so no IPO forms lying around your house because that was just after the IPO boom. Nothing like that. Your parents were very conservative and just did normal deposits.
No, I would say, I mean, my father had one investment I forgot to mention. In fact, my grandfather also had that investment. Coming from Karnataka and an area which is close to where Karnataka Bank started off, all of us, most of us in the family would have some shares of Karnataka Bank at some point of time. And these were not bought in the market, but they had applied during the IPO and the subsequent issues, etc. So that's the only thing that was connecting us with the stock market at that point of time, I would say. But as I started to work just after my engineering, I started to, as I mentioned, maybe in the third or fourth year itself, I was keen to look at finance as career. And I used to keep reading financial newspapers, try to track things, although the understanding was very, very less. But I used to do that. And as I started my career after my engineering, obviously had some income to really go and try what you have understood or thought that you have understood. So I did invest in IPOs. I think at that point of time, a couple of them were good ones, but most of them were tuition fees, I would say.
Yeah.
I don't even remember the names today. But yes, a couple of them where I made a little bit of money were, I think, Maruti, State Bank of India, and Morgan Stanley had a close-ended fund, if you remember.
The
In
very famous
1990s,
Morgan
yeah.
Stanley Growth Fund. Yeah.
And in fact, it was very difficult to get forms for that particular issue. And somehow I had managed to get it and a couple of our friends. And we all invested. And thankfully, we didn't hold it for long because it opened at, I think, if I remember now, maybe 17 or 18 rupees. Whereas, I mean, a mutual fund, it has to start with an NAV of 10, right?
Yeah.
Being a close-ended. And it was also looked at as if it's a stock and has a lot of future opportunities. And we were quick enough to actually book that profit. So
wow.
Yes, I mean, these were, I mean, the three that I mentioned were the ones where we made money initially. Otherwise, all of them were
tuition fees. So this, the forms you got from Morgan Stanley Growth Fund, did you have to pay a premium to get the forms, or you got the?
No, we didn't have to pay a premium, but we had to stand in a queue for quite some time. I remember it was a couple of hours to get that form, and somehow we had managed it. And not that we made lots of money, we didn't have so much money to invest into, but it was a good beginning, I would say.
ROI was good.
Yes.
Amount will be less.
Yes.
So, well, let me congratulate you, because you're one of the very few people who probably made money on that fund in those times. I think that was some fund there. Everyone who was associated. In fact, we had a guest on the Investor Hour, Sridhar.
Okay.
From Enam. He was actually at Morgan Stanley at that time, and he explained what went wrong and how the fund it ended up in the situation it did, because of they had too much money, too few stocks, so they rode up the price, and then they were empty. If they had to sell, they were driving the price lower.
Yeah.
But what a time that was, right? The IPO time. So in this whole period, of course, from engineering till date, a rather large span, which has been like your. Well, let's start with the first one. You've spoken about some of the IPO failures. Which was your first initial big investment failure, and what you learned from it? Do you remember?
There have been many failures. Actually, if somebody says that they have not made mistakes or they have got 9 out of 10 or 10 out of 10 right, I don't think that's true. Either they have not
that's
invested.
Only at cocktail parties.
Sorry?
That's only at the cocktail parties.
Yeah, and or they have been very, very lucky and they have not invested for a long time. Maybe, yes, it is possible in a certain phase in a couple of stocks, but if you have been investing for decades and if you have, seen the investments, I think that's never going to happen. There will always be mistakes. I think many mistakes over a period of time. And once I came into stock markets, obviously the learning also kept increasing. So the bad lemons were there in the portfolio, but I wouldn't say that they were disasters in that sense. Yes, more manageable kind of losses that we had to book. And generally, I've been cutting losses much faster than getting out of winners. So I think in that sense, the amount of loss that we have made on some of the bad investments comparatively is much lesser than what we would have lost if we had taken wrong bets in terms of the portfolio size or in terms of holding it for a longer period in the hope that it will recover, etc.
That's such a counterintuitive strategy, but it works so well. Just cut your losses and let your winners run.
Yes,
but the
absolutely. I think this is one thing if you follow. I think even if you are wrong, and you are bound to be wrong, right? I mean, we say that this is not shooting or archery or gymnastics where you get a bullseye or a 10 out of 10. Even if you get 6 or 7 out of 10 right, it's good from a long-term perspective. And what is more important is out of those 6 or 7 that are winners, how much money you make and how much money you lose, or how much less money you lose on the investments that have not worked for you. I think that's the key for success, especially if you're managing funds for a long term. And definitely this is not T20, right? I mean, this is test match or a marathon. So you have to keep doing same thing over and over again so that you compound it over a long period of time.
Yeah. So I was just saying that it's a counterintuitive strategy because the human tendency is when you make a profit, you want to book it quickly because you don't want to lose the profit. And when something falls, you are saying, let me maybe double down because now it'll rise. And that is the worst thing, right?
Yes,
That you can do.
absolutely.
And interestingly, we've been doing this podcast since May 22. I think in most of our episodes, this idea has come out to be one of the core ideas. Get rid of the underperformers and let your winners run.
Yeah.
And everyone, all of you guys have such wonderful track records. So like they say, just copy the good ideas out there, right? You don't have to come up with your own new idea.
Yeah,
Well,
the good investments are usually the boring investments. They will remain in the portfolio for a long period of time. They won't give you a lot of thrill. They keep compounding at a certain pace. But when you look at it over 10 years, 15 years, you will realize that you have created a lot of money through those investments. I think that's the key for long-term success. It's not about how many multi-baggers you have in the portfolio.
I completely agree. So just to talk about some critical days in history, of course, is the Harsha Mehta, the whole sharp rise and fall. You were in the engineering college then, or?
Yes, I was following it only through newspapers, etc. But the understanding of what had happened at that point of time was really, really less, I would say. But over a period of time, after coming into the stock markets, understood the whole issue in terms of how it unfolded, how it unraveled, etc. But at that point of time, it was just reading in the newspapers.
Yeah, that was some phase, right? The whole country got sucked into it.
Yes,
That
yes.
was some phase. And after
Thankfully, my career started after that. So I think we're outsiders rather than insiders in that sense,
Yeah.
stock market.
Yeah. So whoever entered at that phase, I can imagine, because it really dealt a big blow to people, because what they were doing was not just regular cash stocks, they were doing the badla stuff, which is like a future. Am I right in saying?
Yes, that's right.
So they were all leveraged, and that's why it really destroyed a lot of wealth at that point in
And
time.
also, in fact, the extent of bull run that happened was so swift. In a span of few months, the stocks went manyfold. I think, but also sucked in a lot of other investors who were not looking at investments at that point of time.
They got sucked in. Yeah,
yes.
They all got sucked in. Yeah. Then, of course, we had the FI bull run. When the foreign money started coming in, Morgan Stanley and all these guys came. You came in really after both these spikes had happened in 1996. So the first one you probably faced was the TMT, the IC bubble, 99, 2000, 2001. Take us through that. What were you think? What were your initial impressions? What were you thinking? How do you deal with it? Any episodes come to mind?
Yeah, at that point of time, I was still in equity research, but handling sectors other than TMT. So to that extent, we were all
dealt a lucky hand, yeah. you missed the Harsha Mehta, you missed everything, and now you missed the TMT also.
No, in fact, we were all worried that whether there'll be future for analysts who are tracking some of the other sectors.
Okay.
The old economy sectors.
Old economy, yeah.
So I was handling oil and gas, petrochemicals, automobiles. Nobody was interested to read those reports at that point of time. Mm-hmm. And all that interest was in only one segment, which was tech, and a little bit media towards the end of the rally, I would say. So to that extent, the excesses that happened only in that segment. Obviously, from a price to earnings multiple, various other valuation metrics came into being. PEG to begin with, then price to sales, then what can they do if they continue to grow at that pace for 10 years, 15 years, etc. And everybody extrapolated what happened in the previous 1 or 2 years to say that will keep repeating for next decades, etc. So I think clearly there were excesses. And when you look at markets, you will always have periods of excesses, but this was one where a particular segment, a very, very narrow segment in that sense, especially in the context of Indian markets, was creating all the leadership. So at some point of time, it was bound to crack. And it happened across the globe. And we had to see the mayhem for quite some time.
Yeah. So 2 points related to that. First, you were on the old economy side. And like any old economy analyst, I think those days I was looking at cement, steel, maybe
not much of a difference than what I used to handle. Right?
Yeah, and what valuations? Everything looks so exciting, but no one's interested.
Yes.
How do you deal with that? How do you make an investment case? Guys, we should be buying cement stocks or we should be buying steel stocks.
Yeah, I mean, we kept doing the basic stuff right, and kept asking investors at that time to look at some of these businesses which were quite inexpensive, and if you believe that India would grow, and these were some of the industries which had very low penetration. For example, I'm talking about auto, cement, etc. Right?
Yeah.
So to that extent, the long-term growth roadmap was really good, and the valuations were quite reasonable. Just that there was absolutely no interest apart from the TMT sectors at that point of time.
Yeah.
But I think you keep seeing those episodes every now and then, right? I mean, later on we had the infra engineering
Yeah, we'll talk about that.
kind of a rally where nobody wanted to look at anything else. So you will keep seeing these, phenomenon every now and then in the market. It's just that one needs to wait through that particular moment, not get caught in either the momentum or the greed, or at the same time not lose sight of valuations and the portfolio diversification, etc. Because it's always that fear of missing out is what leads you to make more mistakes. And most retail investors, I would say, in every bull run, they enter towards the end of the bull run, because that is when they would see a lot of media stories, news articles about how wealth has been created. They would be seeing that in their friends' network, relatives' network, and they end up chasing this momentum, and that's typically the end of the bull market. And we have seen that, and in fact, in a light-hearted way, we keep saying that the moment you see your end investors becoming more bullish than yourself, that's the time to be cautious, right?
Yep.
Generally, at the bottom of the market, you are probably more bullish than your
You're pushing. Yeah.
You are asking them to put money into the funds, etc. But there is absolutely no interest. I think that's the point where the markets will bottom out.
Yeah.
But typically, at the top of the market, you will see them becoming more bullish than probably some of the money managers.
Yeah. From your experience, is there any way to deal with this bias? I know this is so ingrained in human brains, but is there a way you can sort of dilute it a little, where you respond more to greed and you run away from a situation where there's fear and probably a better investment opportunity?
Well, it's easier said than done. I think it comes a lot from your own temperament, and something is inherent to you. Many people will not be able to change that. Many over a period of time, maybe through conscious looking back into what has happened, how they've done, etc. Maybe they'll be able to change a bit of that temperament, but it's easier said than done, I would say. But generally, if you look across financial market related books or management books, the advice doesn't change, right? I mean, they may use different words, but the advice remains the same. But the irrational behavior of investors still continues. Maybe there is a different set of investors who are doing that irrational behavior, or different segments which are going into expensive zone, etc. But typically, what you have seen in the previous cycle more or less comes and pans out in a similar way, with slightly a different tilt every time, with different sectors or maybe different kind of a phase, etc. But otherwise, these cycles keep happening, and I mean, only if you consciously try to question your decisions of the past, how they have done, and look back and really take a hard look in terms of what has worked and what has not worked. And typically people focus on what has worked, right? I mean, that's a general tendency, but I think that's the most most detrimental to your long-term success, because you are not looking at the mistakes and you're not trying to correct what can be corrected over a period of time.
Yeah. So just to add to that, the mistakes are the better teachers for you, right? And you can limit your losses, like Warren Buffett says, right? Rule number 1, never lose money. Rule number 2, never forget rule number 1. So you have to figure out where you're losing money, and you kind of try and plug that. But I completely agree with you that end of the day, the books are saying the same thing. You have to figure out how you build your temperament, and there's no easy way to say that. Coming to the second point related to the whole TMT period, you mentioned PEG, the price to earnings multiple in the context of growth, and you mentioned price to sales. Now, this is a pattern, I think, which is recurring, where every bull run comes up with new ratios to justify all the pricing. I think Harshad Mehta was some replacement cost
Replacement.
theory,
Yes.
replacement cost or whatever. And then there was PG and all these come up. How do you deal with these? Because aren't you running a risk theoretically that you may end up missing a genuine shift in investment theory or investment practice?
No, sure. This is one of the most difficult things to really come up with an answer to. And every time some of these bull phases or irrational behavior, it could happen even on the downside, for example, continue to such a point that even some of the seasoned investors will be asking back to themselves whether what they have followed for the previous 10, 20 years is any more relevant or not. So I think, again, there is no easy answer. But again, on a fundamental basis, how businesses run, how valuation works doesn't change, right? If the company is making sustainable cash flows, high returns on cash flow, shareholder money, then eventually, if you are not paying overvalued premium to that particular stock, you should be able to make reasonable amount of money, right? But if anything is wrong in any of these piece, either the valuation is absurd when you enter at the beginning, or there is no cash flow at all, and there is just a fad in terms of following something in the hope that that will become a very large pool of profitability, etc., then there is always a risk. So I think that's where you need to see whether the business models are proven or not, whether they are scalable in nature. If they are scalable, whether the company that you are investing into is in such a position that it can keep gaining market share or gaining leadership position in that particular segment. And one of the most critical things to analyze is how the capital allocation decisions would happen from some of these businesses. Because most of the companies in the Indian context, for example, would have chosen a segment where there is reasonable amount of growth going forward. They may also get the growth coming into the company, but what do they do after reaching a certain size, and whether they're really able to allocate capital in a way that it sustains a higher level of returns for shareholders or increases the return for shareholders is something that you have to critically analyze. And most of the companies which are unable to take those good capital allocation decisions are the ones who will do well in a particular phase, but they will not be able to handle that growth. And either they get into very, very unrelated businesses or allocate capital into such businesses or such projects which will not be remunerative as much as what they used to do in the past, etc. So clearly, I think capital allocation decision, the scalability, the overall business model, whether it is sustainable, proven, etc. These are some things which will not change whether you are looking at a new age industry or old industries, this market or any other geography. I think these are some fundamental things that will continue to remain relevant.
So this is another test for our viewers and listeners, that whenever a phase comes and these new ideas get sort of pushed around, you have to stick to your proven ideas, and you may miss it. Like, for example, if one were to take this whole these what do you call them, platform companies which don't have a revenue model, you're going to miss them, and you're going to feel pretty stupid not having applied in the IPO, etc. But if it doesn't fit your model of cash flows, return on capital, allocation, profitability, it's better to stay out of it, I think.
Yeah, and one more thing, Rahul, just to circle back on that. A lot of people want to make money on the stocks which have been in the news and which somebody has already bought, etc., because they feel, again, the fear of missing out. But there are several other businesses in this country where you can still make money, right? So all that you need for a good portfolio is maybe 40, 50, 60 stocks, depending on the size of the portfolio. You need, I mean, there are 5,000 odd stocks in the country. Not all of them are tradable, investable, etc. But that's a large universe. Out of that, you have to really pick and choose a few businesses that you like and at valuations that you are ready to really invest into. So from that perspective, you will keep missing out many of these investment ideas. forget whether they are from a new set of businesses. Even in the old set of businesses, many a times you will miss out. But I think you just have to move on and look for other opportunities. It's not end of the road. I mean, you have to keep batting. You have to keep staying at the crease.
You need to be a Dravid.
Yeah,
Stay
yes,
longer. It'll
yes,
come.
absolutely,
Yeah.
absolutely.
Okay. So after the whole TMT thing was, of course, what we spoke of, the whole what do you call it? The infrastructure boom, the capital asset boom, the real estate boom, the build-up boom. Take us through that. By then, you were already managing money.
Managing,
You're
yes.
already managing money. So how was that period for you? By the way, I must tell you, I met one of our first guests on the Investor Hour, exited in 2007 before the whole thing. And he actually published a report. He's saying this doesn't make sense, etc., etc., and he exited. So that's the bar you have to beat now.
No, as mutual fund investors, we are always looking at
Yeah,
relative
you invest.
performance. We will always remain invested in that sense. But we will take due care of our investors' money in terms of where to invest, where not to invest. Yes, coming back to the infra, capital goods, power sector boom, I think that was another a madness in terms of valuation for some of these businesses. And everyone was looking just at growth rather than cash flows or sustainability of those businesses, whether the companies had the manpower and the resources to really execute some of those projects, because it was all going up based on the order inflows and the information around
Land
land
bank.
bank, etc. So I think that was an excess that happened in the world economy part, more so in the infra, power, and some of these capital intensive businesses. Again, we did have investments in that space, kept reducing towards 2007, 2008. But even after the global financial crisis, we did have some of those investments in the portfolio. But over a period of time, we could manage that. And in the entire period, we were able to outperform simply because, end of the day, it's again, I'll come back to the same point, that it's not about what you have or what you don't have. It's also about how much do you have in the portfolio.
The
Just because
allocation.
you had an infra position in the portfolio, if it is not a sizable bet, if it's not going to harm your overall portfolio returns, it was a manageable risk. Yes, in hindsight, maybe you would say that you could have been zero in that particular stock, etc. But that comes only with hindsight. Otherwise, I would say as long as you know clearly what to avoid, I think that's very, very relevant, because if there are 5,000 stocks in our market and if you're choosing 40, 50, that means that you know what to not touch. And that also leads to your portfolio returns, because many a times I'm questioned by our investors, partners, etc., that we don't see any new set of stocks in your portfolio. We don't see this multi-bagger, that multi-bagger. But how have you generated this kind of returns? It's amazing. And they compare with another portfolio saying that this portfolio has a couple of these winners, but still their overall returns are lower. I think, again, it comes back to portfolio sizing and what is not there in the portfolio. I think very few investors in mutual funds focus on what is not there in the portfolio. A large part of your relative outperformance can also come from what you don't hold in the portfolio. I think these are some of the things, that are relevant. And
Yeah.
During that infra boom, yes, we did have our bad investments, but those were all manageable, I would say.
Yeah, so position sizing is something we'll talk about later in the podcast. But you mentioned that, I guess, as the valuations kept going up, based on your processes, you kept reducing because there's a valuation filter that you all have, and that helped you control it. But what was the most like in that phase where property prices shot up, stock prices shot up, etc.? What was the most striking thing to you about that? What made it unique for you? Like, were you I know as a fund you are fully invested, so that's not a function of whether you're bullish or bearish. The function of bullish or bearish is how it's allocated, how it's position sized. But what was that whole? How self-aware were you that now we are about to have like a crash landing, or this is going to be problematic, and we need to get prepared for it?
I think first and foremost, the valuations. I think those valuations were definitely not going to be sustainable. I mean, if you look at the price to earnings multiple, most of these businesses in the infra were trading at 30, 35 or even higher price to earnings multiples. Hardly any cash flows and a lot of leverage on the books. And with the kind of inflows that were being talked about, when we actually did our ground check, we realized that many of these companies didn't have the resources to really execute. Forget about executing those kind of projects. They had not even taken due care in terms of bidding for those projects because they knew that the market caps were coming because of these announcements in terms of what awards have come on which companies. So to that extent, the entire focus was on winning the bids, not in terms of how will you execute if something were to go against your expectations. For example, we have seen examples where people had just looked at simple broking reports on steel prices, coal prices, and had built it and bid for road projects, for example.
Oh, wow.
And when you're bidding for long-term projects, and if you're taking maybe some secondary opinion in terms of where the prices are headed, and if you take those short-term inputs as your long-term inputs, then there are bound to be problems. That was clearly visible. And many places we realized that while they were talking about starting execution and projects going on full swing, many of those sites when we visited, there was hardly any mobilization of resources, equipments, and the resources that were needed to really do those projects were clearly not to the extent that you would be comfortable. I think those were clearly signs and warnings that were there. And then obviously the valuations were also very, very rich. And the other thing to look at was most of the new mutual fund launches were happening in the infra theme, right? The amount of money that was going into the infra theme and the amount of money that was invested in the diversified funds in this basket was so large that it was not sustainable. I mean, you can't have one or two segments of your economy driving forever. Yes, it happens in certain phases, but as long as valuations are fair, you can play that particular investment theme. But beyond that, it becomes really, really risky.
Yeah. So what I find interesting is that when you analyze it, I think it happens post every bull market. The signs were always there, right?
Yeah.
It's whether you were willing to see them or not.
Yeah.
Anyways, we jump straight 10, 12 years to the pandemic. When did you first hear about something is happening and start to think about, do we take action or not? And then talk us through how it played out. 2020, of course, was very eventful in that sense.
Yeah, I think by the beginning of the year itself, the international media and even Indian media was already covering the cases that were being reported elsewhere. And the signs were not encouraging. But none of us had thought that it would come and hit us so fast and in that magnitude, I would say. Even as late as March, for example, while we were all worried about how cases were spreading throughout the world, we never had an inclination in terms of we would have a pan-India complete lockdown for weeks, etc. I think those were never really in anybody's base case assumption. So I think all of us were taken by surprise. And this is something that none of us had seen this in generation, right? And how could you prepare for that? We couldn't. The only way the portfolio survived that was the due diligence that you do always, that you invest in businesses which are supposedly being run by managements which have seen cycles, which have waded through that volatility. And you have not overpaid for those investments. If that has remained intact, then obviously you can hope that even when this crisis comes and goes, you will be able to come out of it in a rather insulated way, I would say. But beyond that, I don't think we could position ourselves in a particular sector or a segment saying that this is going to be completely insulated, etc. I mean, I don't think that would have worked at all. And as it is, I mean, as I said, we don't take cash calls at all. So we don't believe in taking cash calls. It's a double-edged sword. We remain fully invested. Maybe we had a little bit more cash than what we generally used to have. But other than that, we were not prepared in any sense for the aftermath of the pandemic.
So I like what you said, because you're saying we are investing in really good companies and the good companies should be able to manage the crisis that come their way. And if we
Or at least better than the rest of the
better,
company,
yeah,
which
on
means
a
on a relative
relative
basis,
basis,
they should be
so
better.
you should come out better on the other side. So that, that's a very good way of thinking, because if you were taking a cash call at your end or taking a sector call at your end, you're only adding the levels of
Yes.
risk to the decision making process.
Yes.
The more parameters are there are, the
Yes. I
the
mean,
more risk there is.
the reason that I mentioned that you should know what you're not going to do is simply because reduce the number of decision points. Because
Yeah.
go back to what we discussed earlier, not every decision of yours is going to be right. So
That's
to that extent, you minimize the number of decision points, more likely that you will be making less number of mistakes. Although it's not a guarantee, but at least you can hope
Yeah.
for it.
And the decision making points that you are keeping with yourself, you become damn good at it.
Yes,
right?
and also, I mean, we clearly believe that once an investor invests into an equity mutual fund or a debt mutual fund, the person has already taken a call in terms of investing into that particular asset class. So after that, I should not be trying to do an SIP further in terms of when to invest that particular sum of money into the markets, etc. The mandate is already given that you have to invest into equity, right?
Yeah.
Then your job is to decide at that point of time what are the best investments that you can look for and how to size those investments. That's the only thing that you can do. But you cannot say that, I mean, the money has come into the fund, but I am bearish and I will not invest in it. That's not something that we do.
Yeah. So I also like that fact, because you're very clear on your mandate. There's no confusion.
Yes, yes.
And so I know there are other funds out there. One of the funds, a relatively popular fund, they don't take a cash call, but they simply say, if we don't find enough stocks, we'll end up with more cash, right? So I guess everyone has their own, paths to their own nirvana in terms of their investment.
Yeah. I mean, the journey could be different, but I think destination is what you aspire for is the same. As long as you have the same investment discipline, hopefully it should work. It may not work in a certain phase, but over a period of
time it should work. Yeah. And I think for the viewers, you have to. That's why the choice of which path to take is very important. You should think through that. If you're going to go to Harsha and say, "Hey, Harsha, the world's collapsing. There's a pandemic coming. Why aren't you holding cash?" That doesn't gel with the investment objective, right? Then you need to be somewhere else. So you have to have thought through, and then you bet, and then you stick with it. Okay. Moving on. So we've got a little bit of history now on how you've dealt with and been through these cycles. Along this, we've discussed a little bit about your stock selection process. Let's talk about it again and take us through how would you define your stock selection process? What are the key factors that you look at? And also in that, if you can highlight some areas where you think you are more focused than you generally see around you, just to give us a flavor of that, please.
No, Rahul, frankly, we don't want to say that we are different from others. I don't think, I mean, that's true. I mean, we do the same kind of analysis as many other investors do. Many other investors may probably do more than what we do. Just that we stick to what is our investment philosophy. Generally, we have been investors who are looking at growth at reasonable price. Mm-hmm. And there is an explanation for why we do this, because it's our belief that if you are focusing on the top end of the market, which is your high growth, high multiple basket, or the value bucket, the amount of patience that you have to have, or the risks that are there in those particular buckets, are much more, in the Indian context especially, as compared to growth at a reasonable price, is what we think. It's not that value investing doesn't work, or high growth, high quality investing doesn't work. We do have stocks from these buckets as well in our portfolio. But when you look at the weighted average valuation of our portfolio, generally our valuation level would be very reasonable. And we look for an expected earnings growth, which is a couple of percentage points higher than what the benchmark is expected to do. Over a period of time, the benchmark expectations will change, our portfolio company expectations will change. But as long as that spread remains a couple of percentage points in favor of the portfolio, ideally that should result into outperformance without taking too much risk on the valuation. It's a simple philosophy that we follow. And within this, we look for businesses which are proven, as I mentioned earlier, which are scalable, and look for companies which have a certain degree of competitive advantage and a sustainable competitive advantage in those particular industry segments. That's something that we are really critically looking at. We focus a lot on management. It's not so black and white, but over a period of time, you are able to judge the management in terms of their integrity, in terms of whether their interests are aligned with the minority shareholders, whether they have been fair to minority shareholders in the past. How have they taken the company in the past through various cycles, various such issues. And also we keep meeting the same managements every quarter, every 6 months. And we kind of know what they've been speaking over a period of time, that they've been sticking to that. Yes, every phase is a different phase. Every cycle may throw up different challenges. But some of the changes that they're doing, are they in line with what a minority shareholder would really want to see? Are they really increasing risk of the business just to satisfy certain aspirations, or whether they are really focusing on maintaining the profitability as well with growth? And end of the day, the cash flow is something that is very, very critical, right? You can have all kinds of other numbers in the balance sheet and the profit and loss, but you can't really manipulate cash flows. And that is something that will differentiate companies which will sustain their growth and valuations over a period of time from the others who will not. And the valuation is always the final filter. I'm not saying that there is one way of looking at valuation. Every industry is a different one. Every phase is a different one. You can't say that at a particular valuation I'll always sell, and at a particular valuation I'll always buy. If you were to do that, then it would have been so easy that everybody could make just an Excel sheet and manage investments. That doesn't happen. But various valuation metrics, starting from the simple price to earnings to price to book, EV EBITDA, discounted cash flow, all of these matrices are really useful in terms of comparing a particular business in terms of its own valuations with its history, as well as how it is with respect to the peer group. I think all of these decisions end up contributing to the final decision, which is of buying or selling a particular investment. And in our scheme of things, we have actually made sure that you don't get into a business where you are not comfortable. So we don't invest in any stock where we have no management contact, for example.
You don't invest in a stock where you have no management contact.
Yes, if there is no management contact, we will not invest into such businesses. Okay. That's point number one. Second is, we have already curated our investment universe. It's currently about 450 stocks. This may be 10% of the overall number of stocks that are listed in the country, but in terms of market capitalization, probably 90% of the market capital of the country. So to that extent, we have a clear focus that what we will not do to begin with. And within the bucket that we are focusing on, then we look at all of these issues and try to see what fits the mandate of that particular fund, because the fund mandates also very, very different, right? There are market capitalization limits, there are thematic exposure limits, etc. So depending on that and the liquidity, then we decide whether a particular stock can go into all the portfolios or some of the portfolios, and if at all, to what level in terms of the portfolio size, etc.
Oh, nice, very comprehensive. I want to go to the first point you mentioned. High growth, highly valued, and value stocks. Now, typically, most investors fall into either of the bucket. The reason being, when they think of investing, they've all grown up with the old Warren Buffett style of investing: buy cheap stocks and wait for the market to correct. And like you mentioned, that sometimes you have to wait endlessly for the market to correct. And sometimes they don't correct at all. What I think technically you call a value trap. You think the stock is cheap, you think the market is mispricing, You go and buy, but it turns out the market was not buying it for a reason. So it's a value trap. The high growth, high valuation, they are on the headlines of every newspaper.
Yeah.
So that's where you fall into that. So I like this classification because the growth at reasonable investing is like a gray area which you have to define, because what is high growth, what is a reasonable valuation, you have to figure out. But then I think what you're telling us is that you already got a framework in place where you've got these companies that you want to do, 450 companies or what that you've researched. You're looking at management, you're looking at all of the things that you mentioned, whether they have a moat, to use a technical word, whether they have the increasing market share, et cetera, et cetera, et cetera. So have you always stuck to this growth at reasonable price approach all these 10, 12 years that you've been managing all these wonderful funds who've declared these wonderful returns? Or have you had a pivot? The reason I ask this is because Buffett himself had a pivot. He was value, and now he's more like GARP, fair price for a good company as against a good price for a fair company.
Yeah, I would say that there will be phases where you will have maybe little more of high growth, high multiple stocks in your portfolio, or maybe you'll have a higher proportion of value stocks. But by and large, over the last almost 2 decades of fund management that I've been practicing, growth at reasonable price is something that I associate myself with. And I feel that while it's a middle of the road kind of an approach, it also comes with lesser risk, I would say. Because in a high growth, high multiple space, if growth for some reason disappoints, and when I say disappoints, it's vis-a-vis the expectations. They may still be growing at 15-20%, but if the expectation was to grow at 30-35, for example, then there is a double whammy. One, your earnings will start to get downgraded, and you will also have the multiple contraction. Similarly, in the value bucket, my firm belief is for that value to get unlocked, there has to be some external trigger or an internal trigger. And as mutual fund managers, we manage transient money. We are not given money for our lifetime or endless period.
Mm-hmm.
There are investors who are coming in, there are investors who are going out. So I can't be taking a risk which is more than the average risk that an investor is looking forward to. If it was a proprietary money, maybe you would put in a completely value stock for maybe next 15-20 years and hope that at some point of time it'll get unlocked. So, and also, how will it get unlocked? Either there has to be a management change. If the existing management is leading to that value destruction, there has to be a management change. Or the value destruction could have happened because they have gone into unrelated businesses which are not yielding as much as what the market really expects from these businesses, etc. Then there has to be disinvestment of some of those businesses. Or they have to really think through in terms of changing the overall business model and come up with a new business model which will work, etc. So, and every company will not be able to do some of these changes. It's not so easy. So to that extent, my belief is if you enter into that segment, either your investment horizon has to be very, very long, or you have to be ready to be a kind of
nimble,
accepting some of these mistakes and move out very fast. But it's difficult, right? It's not as easy as growth at reasonable price or a high multiple stock.
You can't have a structure to it.
You have already bought it at such a low valuation. If it falls further, you will always feel that, there is no further risk. The risk may not be in terms of another derating. It may be in terms of the relative performance, right? So again, some of the things that I've discussed have been more in relation to how mutual funds are supposed to work, because end of the day, it's not about making absolute money. It's about, yes, we have to make absolute money, but in a relatively better manner. So that's where we try to focus on, rather than saying that every investment has to make me a certain amount of hurdle rate, etc.
Yeah. So the thing with these triggers is, a lot of it is just going to be cover. Do you have access to the news? And that's in the realm of speculation, right? That's when you get caught off guard.
Yeah, and also if you look at some of these value buckets, they have tended to do well in certain phases, because those are the phases either you have already exhausted all of the other investment ideas and people are coming in here because the liquidity is still huge and they're betting on new set of companies. Or as you said, there are some news items which are saying that certain things would happen in certain businesses, etc. So you have to be really careful in that sense. So that's where I would say that growth at reasonable price, while it may sound like a cliche, but we know what we mean by reasonable price. While for an outsider, it may sound like it's something.
Yeah, it sounds vague, but there's a process to it. You know what is reasonable.
I'll take a couple of minutes to explain that.
Please, yeah.
For example, if we believe that markets are at a fair range of valuations at any point of time, then our portfolio, we won't try to be very, very low on valuations. We would try to be more or less in and around those fair range of valuation, because we think that the market is also fairly valued and we are around that. But compared to the benchmark expected earnings growth, our portfolio earnings growth, we will always be higher, which means we are paying fair range of valuation just like the market, but we are expecting higher level of growth for our portfolio companies. If this thesis works, then you should be able to ideally get out performance. But there will also be time periods where market is trading at a very high multiple. In that case, we will be considerably lower than the average market multiple. For example, in October 2021, we felt that the market valuations were expensive. As I said, we can't really go into cash to reduce our portfolio drag, but we went out of certain segments which we felt were very, very expensive. For example, IT mid-caps were almost zero in our portfolios. Some of the consumption stocks were not there in the portfolio, again, because of the valuation expensiveness. So by doing that, our portfolio valuation was much lesser than the market valuations at that point of time, whereas the growth still remained more or less in line with the market. So that's another way of explaining growth at reasonable price.
Yeah, that makes sense. The thing is that this works in a mutual fund world. It's a lot of it is about relative, like you mentioned earlier. But as an individual, it's difficult to if you've got a job, if you're running a business and managing a portfolio, it's difficult to do this all the time. But
for all of those, I think we have mutual funds. Rahul.
Yeah, that's right. You know that many years ago, someone had asked me, how do I decide whether to invest in stocks or mutual funds? And I'd said it's a function of the free time you have.
Yes, exactly. I mean, if you're able to do your own research with the same rigor that a professional fund house would be able to do, you should do all your investments on your own. But if not, then I think it's the easiest way with a low cost you can participate through mutual funds.
Yeah, that's not even, it's not a plug. It makes so much sense because people who are busy. Okay, let me rewind a bit. The day and age of buying a stock and holding it for eternity has gone because the world has become so dynamic. You can see moats disappear overnight.
Yeah.
Today you can see a Google which is trading at 45%, 50% below its peak valuation just because, something changed in the world. Now, if you're not tracking that space, you got a problem. You have to be deep into it.
You mentioned about holding it for lifetime. In fact, very few, while the average holding period of an investor in the mutual fund space has been going up thanks to the awareness that has come through. But it's still very, very low, I would say. For an asset class like equity, it has to be much higher. A couple of years back, we did look at our initial set of investors in what was then called Kotak 30, and now it's called Kotak Blue Chip. And how many of those investors are still remaining with us? Because this fund was launched in 1998. You will be surprised to know this exercise we had done a couple of years back, and there were only 80 investors, 80.
Oh my God, really?
Yeah, and most of them naturally were employees of Kotak Group at that point of time, who were still part of Kotak Group, etc., who invested at the IPO because that was the first fund from the group, etc. But I mean, that tells you that while we keep talking about long-term investments, very few investors actually are able to practice that. I think that's what, tells you that the amount of compounding benefits that one can see is probably not there because people tend to get out at regular intervals. Although that is changing, I would say.
As a side note, we had Vetri Subramaniam on this podcast recently, and he was one of the fund managers for K30.
Yes.
It was a wonderful podcast, that one. Okay, you mentioned cash flow, and I think the importance of cash flows is growing. We're going to talk about frauds in a moment, how to detect a fraud and how to be careful when picking a company. So we'll come to that. But uh, did you speak about return on capital and how important is it in your process? Can you
Yes.
maybe articulate that a little bit more on, because a lot of people are just looking at valuation, and I think the return on capital for an average investor is something which is highly underrated. I think they need to look at that a lot more than what they're just looking at the valuation multiples.
First of all, for any business to be profitable and sustainable over a period of time, the return on capital should be higher than cost of capital. That's a simple logic, right? And anybody can evaluate this. If you are able to earn more than cost of capital, then obviously you are building that additional returns, and over a period of time that sustains your growth, etc. A lot of investors, I would say, I'm not just saying retail investors, but even professional investors tend to look at just the growth or the EBITDA margins rather than return on capital. Why do I say that? Because market also at various points of time tends to re-rate the companies which are improving their margins or improving their growth rates. Yes, these two can also lead to higher return on capital employed, but we need to see whether a return on capital can be endlessly taken up, or is there a fair level at which you need to look at increasing your overall growth. Because finally, the value that you create is a combination of growth and the return that you make, right? So if you simply keep increasing your margins, EBITDA margins, or your return on capital, you may be doing that at the expense of growth, which is also not good for the company. So finally, you need to say that, okay, let's say cost of capital is around the double digits or high single digits. And if a company is able to get a few percentage points of spread over that, and if they're able to increase the growth rate from the current 15% to, let's say, 20%, that's a better bargain than trying to take your return on capital from 35% to 40%, but at the expense of your growth, or taking your EBITDA margins to such a high level that you don't really grow. And I think if you look at the FMCG companies in the Indian context, you will clearly see this. Whenever their EBITDA margins grow to a large extent because of any external aid, for example, if raw material prices crash to a very large number, then maybe instead of cutting the prices, they try to invest that back into the business and keep the margins at a lower level so that they grow the market, right? Because finally, your value creation is also coming from growth and, of course, from the profitability. So that is, I think, something that one needs to keep focusing on rather than just one of them.
So the discipline here is, if you make a profit, you are reinvesting it because you know you're anyways going to get a good return on capital. And that's like that gives you that
yes,
amazing
and I would say there is a fine balance between how much you can really increase your EBITDA margins or your return on capital, because at some point of time it will start hurting your growth. So you should be careful that it doesn't hurt your growth and put you into some other problem. But yes, a reasonable spread over cost of capital is what one should be aspiring for.
Okay, interesting. Moving to position sizing, you spoke about position sizing a while back and the importance of it. Talk to us a little bit about how you go about thinking about position sizing, and if you can also bring in an individual element, how as an individual you would do it, just so that our viewers get a flavor of that as well.
Yeah, so we try to build positions gradually. Whenever we look at a new opportunity, very unlikely that you will see that as part of our top 10 or even top 20 holdings, I would say. Even if it is a large cap established business which has been part of our portfolio in the past, now it's coming afresh into the portfolio, etc. But we are usually starting to build that from a lower size weight. And then we wait to see how our investment thesis is working. Over the subsequent 3 or 4 quarters, we tend to get some information in terms of what's happening, whether our thesis is working or not. what is happening to the valuation. Assuming that everything is as per our expectation, then we continue to build our position. And we are also aware of the liquidity and the benchmark weights of that particular stock, because end of the day, your portfolio risk comes from not the top 10 holdings, but the top 10 active weights in your portfolio. So to that extent, you should also be looking at what kind of active weight you are comfortable taking rather than just an absolute weight. I mean, just to simplify this for the viewers' benefit, suppose you have a 3% stock in a benchmark, and if you are taking a 4% position because you are positive, but there is another non-index stock and you have taken 2.5% position. While a 4% position may seem like an absolutely higher level of exposure to your stock, but in terms of the active risk, you have actually taken only 1% because it is 3% in the benchmark. Whereas a non-index stock, which is 2.5% in your portfolio, is of a higher risk to the portfolio. I think that understanding is also key. This is just to clarify that all in the relative world, right? I mean, if you're an individual investor, if you're not benchmarking to anything else, maybe you will have a different way of constructing the portfolio. But in a mutual fund world, I think this is one of the key things to manage the risk vis-a-vis the market and your portfolio.
Yeah. The irony is, in the individual world, people don't benchmark, and they should, because we only remember our winners. We think we've done damn well until you sit on that Excel sheet and you come up with 6%.
Yeah.
And then you realize that, what's the mistake you made.
Yeah.
So there are
one of the other mistakes that generally people do is also not to look at what is the current rate in the portfolio, right? Okay. If you keep looking at it from a perspective that you had bought it at a certain price and it is higher than that price today, you are not really realizing the risk. Suppose a 3% position when it was taken in the portfolio, now it's become a 6%, then obviously the risk is much higher, right? So to that extent, you need to keep looking at portfolio weights on a continuous basis. I mean, the entire investment world is on a continuous basis. You can't just take it and forget it. So to that extent, I think continuous monitoring and making sure that there is no unnecessary risk in the portfolio. I mean, I'm not saying that you should not keep it at 6% if a stock has done well, but you should be aware of what risk it is bringing to the portfolio, whether you're comfortable taking that risk or not. Yeah. And again, it's a question of at what valuation this company is trading at a particular point of time. Maybe if the valuations are still fair, you will continue to hold on. Or if your valuations have come off, maybe you'll continue to hold on.
Yeah. So I also like the way you put it, that you've decided on a stock, you've done all your research, gone through all your notes, etc., etc. And even then, when you are fully convinced, you're buying in small amounts and retesting whether you had got it right, whether what you had projected is going to go right. This is the completely reverse of FOMO. On the one hand, you've come up with this exciting idea, you're coming out of a research meeting and you've been sold the stock and you're excited. But then you say, okay, you know what? We're going to buy it over 1 year. Yeah. So you run the risk that the stock may run up, but the greater risk is that you could still have been wrong in your thesis, which could have a bigger impact. So you're literally controlling your downside.
Yeah, this is the Rahul Dravid way, since you mentioned Rahul Dravid earlier. Because, you can score runs either through sixers or through singles or playing dot balls. Yeah. We have done this interview for some time, although you are supposed to ask me questions. Let me ask you a question. Okay. How many sixers Sachin Tendulkar has hit in tests to score his 15,000 odd runs?
Oh, I have no clue. I don't watch much cricket, but I would say probably 1,000 sixes or 500.
No, he has played 200 test matches and he has hit some 60 odd sixers in the test. But he has scored 15,000 runs because he could bat for almost 30,000 balls. Right?
Wow. So that's the bias in me, right? My bias in me is the big shots make the money.
Correct. And only one person in the test history has played more number of balls than Sachin Tendulkar, and that's Rahul Dravid. Oh, wow. Although he has scored maybe 2,000 runs lesser than him because his strike rate was low. And he has hit only 21 sixers. Oh, wow. So coming to the portfolio side, you need not have multi-baggers to really do a consistent compounding to work. All you need is 40, 50 good stocks who will do reasonably better than the market and you're done.
You can still hit a world record.
That's one approach, but obviously it's very boring. You will not see the names that everyone wants to see in the portfolio, but it is effective way of managing money.
Goes back to the temperament, goes back to the cocktail party.
I'm not saying that's the only way to manage money. I'm saying everyone has a way of managing money, but it works as long as you stick to that discipline.
Yeah, it's like in 2000 going to a party and talking about cement. You're not going to be a very popular guy.
Yeah.
So it's temperament.
Another analogy which I typically give. Hope we have time.
Oh, yeah, ample time. Please,
Okay.
please. Yeah.
For example, when we were in college, I'm sure it was the case with you as well. All of us wanted to have a bike which was same as the other friend.
Right? Fair point.
Yeah. It is time tested. Somebody is running it. You know whether your pocket money can afford it, etc. And you want to be safe. Maybe your first car also you would have done the same. That the most popular ones that you see on the road, you wanted to buy that and run it, right? But as you move up in life, you want to have a car which is very different than everybody. It has to stand out in your building. So same is with investments. I think initially people are happy with whatever returns, consistent returns that they get. But slowly, as you said, if you go to a party and if you're not able to talk about something which is very, very in vogue at that point of time, they feel disappointed. And that's when diverting their energy towards something which is in fad or in momentum starts to happen. And that may or may not give you good returns in the end.
Yeah. This whole thing is rooted in evolution. And you see it in children all the time.
Yes.
That when they're growing up, they're all about group. They're all about, I have the same habit. I have, you like each other. Yeah. But as you age, you want to break out and stand out.
Yes.
Right.
Yes.
So yeah, I completely understand that. Okay. When to sell a stock? What is the process you go through and say, okay, guys, now it's time to get rid of it?
I would say that decision is more difficult than identifying a buy opportunity, because sometimes the valuations go to an extent where you will when you look back, you may feel that you have sold it early, right? So I think the way we do it is more or less similar to the way we approach our new investments. If we start believing that the growth rates would come down or the valuations are expensive, we start to not put the incremental money into that particular stock. That's the first level. So it remains in the portfolio, but keeps going down.
Keeps coming down.
When you actually start to feel that there is still a risk in the portfolio because the growth may fall off more than what you anticipate or the market anticipates, maybe you will start trimming. That's the next step. Okay. But if you have a complete disappointment, either in terms of the governance, in terms of some big change in the business which cannot be plugged immediately, etc., then you completely exit the stock. So it's again just like a gradual process for buying stocks. We approach selling also similarly.
So this basically corroborates and underscores the idea of let your winners run. You don't want to exit your winners, assuming all the fundamentals are in place, everything else is in place, but the valuation is high. So you're not saying his valuation has gone high, I'm running away. You're starting to trim, you're starting to hold back. Yes. So that kind of makes sense. Ride it for longer.
Yes.
Okay, that explains. Fraud. We spoke about fraud a little. Talk to us about fraud. How do you prevent yourself being caught in a situation where you're invested in a fraudulent company? And in case it's happened, mention it.
No, thankfully, it has not happened in the last 17, 18 years.
Maybe one of the IPOs.
Yeah, I mean, I have forgotten the names of those companies. So anyway, it was tuition fees and it had to be there. But as long as you do the due diligence properly and very careful in terms of selecting the stock into the portfolio, I think some of these risks can be minimized. I'm not saying that you will be able to eliminate. And portfolio sizing, that also helps you in terms of not taking such big risk initially. And hopefully over a period of time, you'll be able to find out whether your investment thesis is working or not. I think those are the only ways to manage this. There is no way to expect a fraud will happen in a particular company. I mean, we had this infamous case of an IT company where people lost a lot of money, right? I mean, maybe 6 months back, how could you expect anything would happen? The only way we were, at least at that point of time, stayed out of that was, as I said, I come from Bangalore. Most of my friends, relatives have been in the software industry. And surprisingly, nobody seemed to be, nobody was in that particular company at any point of time. Nobody knew that company in terms of any people really working. So we were wondering, I mean, it is such a large company in terms of market capitalization. We have so many friends and relatives working in the software industry. None of them seem to be working in this company. How is it possible? Etc. Although the kind of issues that came up were completely different, but there were some kind of red flags that always was in our minds. And obviously, we were not comfortable with the kind of balance sheet and cash flows. And we stayed away. And then finally, I mean, it helped us.
Yeah. I think if there is one thing the typical investor looks even lesser than the return on capital is the cash flow statement. They all stop at the P&L, and I think that's not great at all. You have to look
P&L
at the cash.
And the sales growth, I think, is what excites most of the people.
Yeah. So keep in mind, all the viewers and listeners, cash flows. That's what you need to look at. Harsha, talking about yourself a little, how do you think of asset allocation for yourself?
My asset allocation is very, very different. I mean, I'm an out and out equity investor, not in direct equities because that's not permitted, but most of my investments are in the funds that we manage or the ESOPs that we have. And I would say hardly any investments into debt apart from whatever is required from a statutory perspective, the PF and stuff like that, or maybe some balance in the bank, etc. Otherwise, it's been completely equity as a financial asset.
Bullion?
No, not much. And thankfully, my wife also doesn't like so much.
That was going to be my next question. You were saying no. Is it okay at home? What about real estate?
Real estate, I do have, but obviously that is to stay. Otherwise, not as an investment.
Okay. But so I think that takes a lot of conviction to be, because equities by default is like a bullish bet.
Yeah. Maybe right? Those who are watching should not follow the asset allocation that I follow, because my risk appetite could be very different than somebody else's, right?
Yeah, I think
I mean, I'll go back to a little bit of the advice that my father had given. So my father, obviously, he had no knowledge of stocks in that sense. So he used to say that, see, it's like a job in a bank. The cashier handles a lot of cash, but it's not his. So remember that it's not your money, it's somebody else's money. And you should take only the risk that you will take as an investor, assuming that all that money is yours. So I used to tell him, although I don't know how much sense I made to him because he didn't understand the concept of portfolio risk, asset class risk, etc. So I used to tell him that, I mean, I'm taking actually lesser risk than what I would take on my money. So investors' money is safe. So to that extent, I think what you do with your own money is very different than what you do as a fund manager, because you are managing public money. So my investments are obviously all into equity, and I'm happy about that.
Yeah, and I think to the people who understand and have a view, it's fine to bet on your ideas, etc. But typically, what I've found is that in a country like ours, which has a huge opportunity, but there are also risks because we are still a nation that is developing. You have to have a little bit of hard asset, not a lot, for a rainy day. And real estate. Now, there's a question I'm going to ask you about your kids, but typically, if you have kids, you want to give them a place to stay. Don't give them anything else. They may get spoiled, but maybe give them a place to stay.
So I was also very, very, very clear in my mind that if I have to make a career in stock markets, which is very volatile, I have to have a place of my own in Mumbai.
Yeah.
So at the age of 27 itself, I had purchased my first real estate, even before I had a car. So to that extent, I was very clear that that gives you security, and then you can do what you want to. But
that kind of prioritization is genius. buying a home before a car is genius. I must say that.
I don't know. If you tell anybody in today's time, they will laugh at you that, this is old generation. Obviously, we are of old generation.
The car is the epitome of social status. And if you can look away from that and buy a house first,
Yeah.
I think it's genius, if you ask me, my view. Okay. Children. How many kids do you have? Sorry, I should
I
have
have
asked
one
that before.
daughter.
You
I
have
have
one daughter.
Yes.
Do you talk to her about money and importance of money
No,
and
she's
saving?
too young at this point of time. She's just 7 years old. So to that extent,
7, at that age, girls can teach their fathers a lot. I should know. I have two daughters.
yeah.
Should start soon before she starts teaching you about money. Okay, we'll move on. But uh, uh, you mentioned about your spouse, right? She's not like hung up on gold per se.
Yeah.
But let's say she came to you and said, "Hey, Harsha, I saved up a whole bunch of money in the pandemic. We didn't go all for the fancy vacations and all the meals and all that." If she came to you and, assuming you're not a fund manager for a moment, and she said, "I have this 1 crore rupees lying around. What should I do with it?" What would be your advice?
Very difficult. I can't think of anything else other than suggesting to invest in equity.
Equity.
And thankfully, she is in a profession which is very, very different. And I would say it counterbalances that the risks that are there in the financial
Oh,
world.
that's nice.
Yeah, she is a maxillofacial surgeon. So to that extent, it's a completely different field,
Wow.
completely insulated from the economy in that sense.
Wow.
So it works.
And think about the other advantage being there may not be a debate on valuations.
Absolutely.
You have your way over there.
The only debate would be, maybe we should have invested in something else which would have given higher returns, etc. But
Yeah,
those discussions will always happen, right?
always. It should happen.
Grass is always greener on the other side.
Yeah. One question which if you're comfortable talking about, your thoughts on giving away wealth. I know you're young, there's a long way to go, but any thoughts you have at this moment?
Yeah, I think, I would say that in a certain way, we are already doing it, not giving away wealth, but at least creating wealth for our investors. I think the mutual fund industry has made even a 5,000 rupees retail investor to participate in wealth creation, which was going to be very, very difficult for that kind of that level of investments otherwise. So in a way, yes, we are helping our investors to create wealth. But yes, at some point of time, giving away one's personal wealth will also come in terms of thought process. But at this point of time, I would say that I'm still not in the phase that I can really think of giving away my personal wealth.
Yeah, and I appreciate your answer because it's typically something that comes a little later in life for whatever reason.
Yeah.
And Buffett was criticized for decades for not giving away money, but then one soup, he settled it. He wrote a $20 billion check or whatever it was. I don't remember.
Well, another thing is, since all along I've done only investments, every time you see money, it seems like a raw material, right?
Yeah.
You want to use it in a way that you create something. Yeah. The question is, what do you do with that? It comes later, but I'm saying initially it's always to make use of that and create something more and then think of what to do with that. So that's how it works, I guess.
Okay. Before I go to my last 2-3 questions, I want to talk a few minutes about India. Sure. So, India's had a start in 1991-92. It stalled. Then we had the Vajpayee government and it stalled. And then India's had these sputtering kind of growth, if you will. But at least in my all these 20-30 years of life as a professional, there seems to be the maximum conviction about India's prospects today as compared to ever before. So I'm always picking myself and saying, what is different now? Why can't it again fall flat like it did in the past? So talk to us. What if you're all equity, so you're bullish on India? Talk to us about what gives you that conviction. What's different now, and what gives you the conviction that India could really make this its decade and come out really, wealthier at the other end.
Rahul, you mentioned that we have seen phase of high growth, then falling back a bit, and then coming back again. But I think while that is true, but if you look at a 20, 30 year timeline, India has achieved a lot, right? Our economy has grown maybe 10 times or more in those 30 years. Our markets have gone up quite a bit. Uh, if you look at the kind of wealth that has got created through the markets, that has been very, very significant. So I would say rather than looking at every short phase, we need to see how India has progressed over a period of time and how can we progress from here on. So I think very, very a strong roadmap, I would say, for India, especially given the dislocation that has happened in the global trade and commerce, in the global geopolitics. And at the same time, I think we are also taking steps to correct some of the things where we were lacking vis-a-vis globe. For example, the capabilities on the manufacturing side. While we have created a lot of capabilities on the outsourcing, especially IT outsourcing, and in the services sector, but in the manufacturing space, somehow we were unable to really make those strides. I think now it's a really a very, very significant opportunity for India. One, I think the excesses that were there in the manufacturing segment post GFC are kind of getting cleaned up, which means that for our own growth as well, we would require more investments coming in. At the same time, there is a space that is becoming vacant where India can compete with other nations. Yes, over a period of time, we have also cleaned up some of the drawbacks that we had, either on some of the cost side or on the taxation, etc. So I think now if we can compete with the global world in terms of the quality, in terms of the logistics, in terms of the trust, I think we can definitely build our manufacturing capabilities even for the even to cater to the world in that sense. And already there is a geopolitical situation where the world is no more as confident as it was in the past to rely entirely on China, for example. You have Russia, Ukraine in the background. China, Taiwan have been aggressively posturing against each other. So in this context, you could question that how many of the global large corporations would still go to China and be dependent on the same source of supply, etc. The answer is they will start to look at alternative sources, and India definitely has a chance. I'm not saying that we are the only ones and everything will come to us, but I think we have a significant opportunity lying ahead of us, and we should be able to make use of that. And also in terms of the portfolio flows, for example, India has always been a capital-starved country, and we rely on foreign capital for our growth, which is very, very critical. Now, India has outperformed all other emerging nations on a US currency nominated basis for last 20, 30 years. Okay. And consistently our weight in the emerging market basket has been going up. So maybe 7-8 years back, every $100 that were coming into emerging market funds, maybe about $6 or $7 used to come to our country. Now that has gone to about $14.5, $15 for every 100, assuming that the portfolio manager is neutral. Now, in a situation where people are going to be less confident on global growth, and the countries which are more dependent on global growth, for example, China, Taiwan, Korea, etc., are more export dependent than India. So to that extent, at least for the next foreseeable future, seems like their growth is going to be more affected than our growth, which is more resilient because of our domestic economy. Then naturally, you can expect some bit of an overweight. I'm not saying that it's going to happen next month, next week, etc. But over a period of time, India weight should not at least be lower than the benchmark weight in terms of the flows, which means whenever the emerging markets flows start, you will start to see maybe $15 or more for every $100 coming into the country. And you look across the investment world, most of the legendary investors and their funds have not had any exposure to India yet. And we are becoming the engine for global growth as we speak. And how far can they go in terms of ignoring our country? So at some point of time, all of this will culminate into more capital flows, more growth, and hopefully, if there are no self goals, I think we should be able to really uh, uh, get a large chunk of global trade and commerce. Then anyways, there are various other pieces which continue to support our growth. For example, the resilient domestic economy, the need for investment into infrastructure, which continuously has been happening, irrespective of which government comes to power. I think it's irreversible, right? You will have to look at making investments into infrastructure, and that will keep aiding certain pockets of our economy. The consumption, which was one of the only areas where India was actually firing, whereas other engines were kind of disrupted. Now we are entering a crucial phase, right? I mean, we all know that whenever per capita income goes beyond the $3,000 range, you will see a huge level of consumption. We are seeing it in front of our lifetime, right? How things have changed over the last 10 years. And look at what could happen over the next 10 years when you actually move into the potential J curve in terms of consumption demand. And anyways, I mean, we have skilled labor, we have got good telecom and other infrastructure capabilities. We have got a large population which is conversant in English, which is using mobile phones. I think the opportunities are really immense for this country. It's just that we have to keep our head down and keep doing things that are supposed to be done, and not worry about the global volatility. That's going to be there. I mean, tell me one year or one phase where there were no risks in the market or there were no issues in the global market. Those will keep coming, keep going. I mean, you spoke about 1992 onwards. We have seen many large crises during that period, right?
Yep.
Despite all of that, India as an economy, as a country, has grown quite significantly. And I'm sure that over the next 10 years also, such kind of transformational growth should continue to happen.
Yeah.
So I think we are all lucky to be part of this generation where we can be part of wealth creation as well as looking at the kind of the potential growth that you can see in the country.
Yeah. You mentioned self goals. I was going to ask you risk. What are, using your word, what are the self goals that could happen, or what are the external risks that could play in, and India may not realize the potential that is so visible today?
No, I would say we are still a vulnerable country. For example, we are dependent on foreign capital. We are dependent on commodities that come from abroad, especially our energy supplies. So if something goes wrong in the global context and it has repercussions on the costing, then obviously that will put pressure on our fiscal side, and it will curtail our future investments into growth, etc. So definitely that remains a risk. And then the policies, right? Because in a democracy, you will always have consultations, you will always have maybe 2 steps forward, 1 step backward, etc. So in that process, if something goes wrong and if you make policy errors, then I think to correct them could take a lot of time, right? I mean, look at the manufacturing space. For example, while we focused on IT sector as a country, we probably didn't do the justice that we had to do on the manufacturing. So, and that has probably taken us back by a decade or more. So you will realize some of these issues only over a period of time. So that's where I think difficult to say what can become a risk. But I'm saying, yes, some of these policy issues could also be risky areas in that sense.
Okay, fair point. The last set of questions. What do you read, and how much time do you spend reading actually?
See, our work is all about reading, analyzing.
So all day. Yeah.
All day. So it goes on. I don't think you can ever have a holiday where you can completely switch off or cut off from market. So to that extent, it's a continuous one. And all kinds of information is useful. I won't say that. I mean, how it can help you in immediate portfolio construction, you may not understand, but definitely there is something that you will gain from understanding.
You'll connect somewhere. Yeah.
What's happening in the world. The only thing that I would say is whenever you read a report or an analysis, whether it's in the media or in the broking reports or investment reports. I think very critical thing to make sure that you differentiate facts from analysis. I think that's where you tend to get carried away by what's written in a report or what's coming in a news article. You should take facts at face value, but sometimes the analysis could be wrong or may not be complete. I think that's where you need to have your own inputs and make sure that the analysis is right. Otherwise, I think there is so much information all around and it's only increasing, right? So you could end up making a lot of mistakes.
That's a very good point. Take the facts at face value. The rest, you be sure you're reading someone's opinion. Don't
Yes,
don't take it at face value. They may have a bias. Can you name some publications that you think offer value and maybe people should read? Any international, domestic publications?
Yeah, I think all the information that comes on the financial markets are relevant for investors. For example, whether it is Economist, Financial Times, Wall Street Journal on the international side, or some of the business newspapers that we have in India. And these days, even if you are not subscribing to some of these newspapers, you could get most of this information on the website online, right?
Yeah.
So to that extent, I think information has become easy to access. The critical part is how to use that information and what to decipher.
Any recommendations for what can help our readers become better wealth creators? And what can they do to become better stock pickers, apart from listening to this podcast and following the process? Anything else?
I would say three important tenets of investing or successful investing. One is regular investments. The early you start is better because you have a longer investment horizon. There is so much more that you can do in terms of compounding. Second is to have asset allocation, because while I mentioned about my asset allocation, that may not be suitable for all investors. I'm making that point very clear. But whatever is suitable to your risk appetite, you should be doing that. And that is something that you have to keep monitoring at every point of time. And the third important tenet is the long-term focus, because most of the decisions that you have taken with great due diligence also can go wrong in the short term. But as long as those decisions are right and you have a long-term focus, you tend to do well. I think these are the three important things to remember.
Simple. Like they say, right? It's very simple, but not easy. So
no,
yeah.
Most of these things are not really easy. Very, very difficult to practice. I mean, simply people say that if you have to be successful in stocks, you buy low and sell high. But how do you do that? That's difficult, right? It's always about controlling greed and fear, and it's easier said than done.
Yeah. Okay. My final question to you: what is the one idea you would want to leave the listeners and the viewers with, that they can think about and mull over?
No, I think most of the viewers, I'm sure, have been investing into equities. And for them, I think just to make sure that you remain for the long term and not get swayed by what happens in the markets every now and then, and keep your focus. And for those investors or potential investors who have not invested into equity, I think risk is there in every asset class. It's just about taking what is the right amount of risk from your perspective. So don't completely avoid equities. Take as much as you can bear and start small. And over a period of time, you will realize that if the volatility that you are worried about in terms of equities, it's only for the short-term investors. For the long-term investors, that volatility is actually a friend. And if you're making systematic investments, regular investments during that volatile period, you end up making a lot of wealth over a period of time. So I think make volatility your friend and keep looking for investments from a long-term perspective.
Yeah, and just if I may add a point, think Dravid versus Sachin, and don't definitely think like me about 1,006s. So the stat, remember that. You want to be there.
Yeah, if you want entertainment, there is T20 and Bollywood.
There's T20. There you go.
Otherwise, I mean, there are other ways.
Yeah, of course. Harsha, many thanks for taking out the time on this Saturday morning. It's been a wonderful conversation.
Thank you so much, Rahul. I really appreciate it. Thank you.